पैसा बोलता है में फिर से आपका स्वागत है. वेलकम बैक टू पैसा बोलता है. Today I am going to talk about two institutions which have decided to merge with each other. Basically, the father is going to merge into the son. Normally what happens is the son merges into the father. In this case, the son has become much bigger than the father, and the father is struggling to raise capital, and therefore the father has decided to merge with the son. What I am talking about is the HDFC twins. This is a major event in Indian markets because both of them are in both exchanges in the top indexes, one both in the Sensex and in the Nifty, and therefore a replacement has to emerge because HDFC will cease to exist once this merger is completed, and I personally believe within the next 1 year this will happen. Its Housing Development Finance Corporation was incorporated in 1977. It was basically does lending for real estate. It does 59% of its lending comes from its own lending operations, and its 26% holding in uh, in HDFC Bank. Insurance contributes 28% with life and 15% from general, and asset management company offers 2.12%. HDFC was incorporated in 1977 and holds 26% of HDFC Bank. The operations of the company mainly are standalone lending and lending through HDFC Bank. It has both life and general insurance arms and also runs a successful AMC business. But the fundraising of HDFC Limited, which is only an housing NBFC, has become difficult. And also, the real estate market has been in deep slump in India, and there has been a lot of financing of big builders by HDFC which are not being serviced properly. Therefore, HDFC has been struggling for some time, whereas HDFC Bank is a universal bank and has access to funds. In fact, Aditya Puri is supposedly eased out with no role in HDFC Twins because he was objecting to the merger. This is because HDFC Bank has grown very big and outgrown the father. It does not require HDFC to merge with itself. Morning Context and Ken have written detailed articles on the problems of HDFC. However, it is better that these two merge because HDFC is too large to fail, and has it is better that if it can correct itself by merging with HDFC Bank. But whether such a merger will be good for for HDFC Bank, only time will tell. Aditya Puri felt that the bank could grow better without merger of HDFC. But at the end of the day, the die has been cast and the merger is going to happen. The RBI has approved it of some special conditions for HDFC Bank for it to allow them to digest this further. After this digestion is over, HDFC Bank will become one of India's largest banks and maybe even the second biggest bank after State Bank of India, and ICICI will also struggle to keep up with it. While this is happening, HDFC Bank has announced an aggressive path for growth by opening a lot of branches. HDFC Bank was also beset with lot of problems, especially in its credit card division and digital banking. In fact, the RBI had taken a rare step of admonishing HDFC Bank and stopping it from issuing new credit cards. Those problems have passed, and the bank has been allowed to issue fresh credit cards. But for many quarter after quarter, HDFC Bank has been growing at net profit of 20%. In fact, for the year just passed, HDFC Bank declared a net profit of 45,997 crores. The net profit for 22 was 38,052 crores. So basically, just shy of 20% is the growth period. Net profit for this quarter alone was 12,595 crores. So, this shows is the growth of HDFC Bank's income has slowed down slightly a bit. The NPA also has come down to 1.12% of total advances. The CASA has come down from 46 to 43%. This is because there is lot of competition from small banks, IDFC, IndusInd Bank. Net interest margin is 4.1% and the capital adequacy ratio is very comfortable at 19.6. At current market prices, this is about 10 days back from when you are seeing the video, when the price was 1692, just the day after the results was announced, the dividend per share was 19 rupees, EPS was 222.6 and the book value 519. The bank was just was transacting a shade above 3%. Its book down from its extreme high positions, where at one point of time it was between 4 to 5%. The bank was trading at the higher end of its 52-week high of 1702 and way above the low of 12 point of 1272. The PBI ratio worked out to be 21.5. HDFC Bank was known to be a strong retail bank and is still a strong retail bank. 46% of its profits came from retail, 14% from treasury, only the rest from other banking operations. So, corporate loans is not a very big portion of HDFC Bank. Pan India, it has a presence in 21,683 outlets, which the new manager Shashidhar wants to grow very aggressively. It has 6,042 branches, 15,431 ATMs. But more than that, is the kind of profits it's generating means that it can keep on, and only a small portion of that is being given out as dividends. So a lot of capital is being added to the reserves, which adds to the equity and the capital adequacy ratio of the bank and allows it to grow faster and better. In the future, the banking space is going to be dominated by HDFC Bank and ICICI. So whenever there's a big dip and the prices are coming to the near 52-week low, it makes great sense to buy into HDFC stock. In the near term, with high interest rates and very low credit demand, the bank's profits may be affected. But once the relative turbulence of the merger with HDFC and this current tight conditions ease, HDFC Bank can be invested if one is willing to take a 10-year look at the bank. Thank you for watching पैसा बोलता है. पैसा बोलता है में आपका स्वागत है. मैं आनंद श्रीनिवासन. मैं सिंगापुर आ रहा हूँ 29 अप्रैल. सिंगापुर में हॉलिडे इन में एक इवेंट है. बहुत सारे हॉलिडे इन हैं सिंगापुर में. मेरा इवेंट हॉलिडे इन एट्रियम ANIHG होटल में है और उसका नंबर 317 आउटरैम रोड सिंगापुर 169075. Once again I tell you the address in English. It is 317 Outram Road, Singapore 169075 and the name of the hotel is Holiday Inn Atrium. I will see you in Singapore. Thank you for supporting Paisa Bolta hai.